Investments. Companies make investments for three reasons. First, companies transfer excess cash into investments to produce higher income, either through dividends or through interest. Second, some entities such as a mutual funds or pension funds or a 401k fund are set up specifically to produce income from investments. Third, companies make investments for strategic purposes. An example would be an investment in a competitor, in a supplier, or even a customer in order to establish some relationships. Short-term versus long-term investments. Short-term investments, these are investments that mature between 3 and 12 months and are considered short-term. Management intends to convert into cash within 1 year or the operating cycle, whichever is longer, are readily convertible to cash, and are reported under current assets and are similar to cash equivalents. This traditionally will be under the classifications, and we will see this as we go through this chapter. These will be trading securities. Other types of investments that we're going to learn about are going to be long-term investments, and usually these are equity investments in another company, buying shares of another company. It's not readily convertible to cash, or not intended to be converted to cash in the short term. So although you could trade or buy the shares online and easily convert them to cash, the intention is not to do that, but to have an equity investment or own the shares of another company. Additionally, long-term investments can be funds earmarked for a special purpose, such as a bond sinking fund, or investments in land or other assets that are idle. They're not used in the company's operations. They're on hand and they're considered an investment, but they're not used in order to produce income. They're not used in the company's operations. They're reported in the non-current section of the balance sheet, often under long-term investments. Debt securities versus equity securities. Debt securities reflect a creditor relationship, such as an investment in notes, an investment in a bond. Remember, we had previous chapters where we talked about an investment in a bond. Certificates of deposit, and are used by governments, companies, and individuals. Equity securities, on the other hand, reflect an ownership relationship, such as shares of stock issued by companies that are purchased by another company. These would be recorded at cost plus a broker's fee. Debt or equity, short-term or long-term. Equity, percentage of ownership. These are 5 of the classifications that we're going to learn about in the accounting treatment. So we have trading securities, which can be debt or equity. So trading securities are held to be traded. The fair value adjustment that is made associated with the trading securities will be found on the income statement. So any fair value adjustment will go through the income statement, and this is known as mark-to-market accounting. These are short-term investment, and the equity investment would be a non-influential ownership less than 20% of the company's outstanding shares. So it's a non-influential ownership if we're talking about an equity investment. Next, let's talk about available for sale. So these are trading securities, either debt or equity, that a company owns and is not trading actively. It's available for sale, but they're holding it more to obtain the interest or dividend revenue. The fair value adjustment associated with these securities would be placed on the balance sheet. So the fair value adjustment will be on the balance sheet. And later on in the PowerPoint presentation, I'll explain a little bit more about fair value. These would be debt or equity, non-influential ownership, again, less than 20%. Next, we'll talk about when you own as an equity only. So this would only reflect or talk about shares of stock. This would be equity only. This would be a significant influence. So the company owns between 20% and 50% of another company's shares of stock. So there's significant influence that the company has over the other company, and will require the equity method in order for the investment, the journal entries and recording the transactions related to the investment will require the equity method. Next, we're going to learn about held to maturity. This is amortized cost. This was covered in the bonds chapter, and so you would refer to the bonds video for any lecture materials or understanding of bonds. So this is debt only, and it's to be held to maturity. And then we have controlling influence, which is consolidation. It's covered in a more advanced accounting course. We're not going to learn about it. We'll just have a page to just kind of understand more about it, just to kind of have a well-rounded accounting education. This is talking about equity only, and it's more than 50%. So when you own more than 50% of a company, you have an ability to directly affect who's been elected to the board of directors, and essentially you have you're a parent to a subsidiary when you talk about a controlling influence. What we'll be learning about in this chapter will be trading securities available for sale and significant influence. Again, held to maturity, we learned about that when we had the debt lecture, and controlling influence is for a more advanced class. So investment account titles, we have some new investment account titles that we're going to be dealing with. Both debt and equity investments are entitled either short-term investments, trading, or long-term investment, and then the name of the company. So it could be short-term investment trading, it could be short-term investment available for sale. These are the types of account titles that we'll be dealing with. The debt investments, such as bonds, will yield interest revenue. The equity or shares of stock will yield dividend revenue. So let's talk about trading securities. The fair value changes associated with trading securities will be reported on the income statement. It's a deviation from historical cost allowed because there's an active market, so you can see the changes to the value of the securities because there's an active market for these securities. And when you have these types of securities and you can report fair value and it's going through your income statement, although it's going to be unrealized gains or losses, it can significantly influence the way that your income statement is considered by investors, because it will add unrealized gains or unrealized losses to your income statement. And this is the type of accounting that Enron was doing. So they were seeing some significant gains on their income statement. However, we know that they weren't doing actual transactions. Well, anyway, to get back to our subject, let's talk a little bit about trading securities. So this is debt and equity securities. The company tends to actively manage and trade for profit. It's sort of like day traders. Their frequent purchases and their sales, let me phrase it differently. Frequent purchases and sales to earn profits on short-term price changes. So they're looking to see if the market jumped up that day. They'll either sell or purchase based upon that, and then sell or purchase it again, trying to gain some additional income from a small or slight change in the market with regard to a price of a security. They're always reported as current assets. So they're always reported as current assets, short-term investment trading, and they're recorded at cost plus a broker's fee. The entire portfolio is reported as its fair value. So you don't look at individual securities, you look at the entire portfolio. It requires a fair value adjustment from the cost of the portfolio, because rarely the cost of the portfolio will be the exact same price that you will see in the market. Any market changes are reported as an unrealized gain or loss because it has not yet been confirmed by an actual sale. The fair value adjustment for trading securities is recorded with an adjusting entry at the end of each financial statement period. So you're doing this only when you're preparing financial statements. You're not doing it daily as prices change. So you're preparing these adjusting journal entries when you're preparing financial statements. And it's equal to the difference between the portfolio's cost, so the entire portfolio of equity or debt that you have, and its fair value. So let's record a purchase. So in this instance, we're recording a purchase of a short-term investment. We're going to signify that these are trading investments in order to let the readers of the financial statements know that these are actively traded investment. They're not going to be held for long periods of time, and then the cash that we spent in order to acquire the investment. And again, it's going to be the cost of the investment plus any broker's fee. Then we have a fair value adjustment. So this portfolio of $11,500 has now a fair value in the open market at $13,000. So we're going to recognize the fact that the investment has gone up by $1,500. So that's going to be a fair value adjustment trading. That's a separate account from the short-term investment trading. And we'll also have an unrealized gain, and we're going to signify that it's going through the income statement by entitling the account unrealized gain income, and that's for $1,500. The original cost of the instrument is maintained in one balance sheet account, so we have short-term investment trading, and the adjustment to fair value is reported in a separate balance sheet account, which is called an adjunct account. We've seen excuse me, contra asset accounts before, but this is a new type of account we've never seen before. So this is an adjunct to, it's in addition to the short-term investment, but the short-term investment trading will always reflect the original cost of the investment. Any unrealized gain or loss from the change in fair value of the portfolio of the trading securities is reported on the income statement as other revenues and gains or other expenses and losses. Selling trading securities. When the individual trading securities are sold, the difference between the cash received and the original cost of the individual trading securities is recognized as a realized gain or loss. So we're not taking into consideration the fair value adjunct account. And this is why they maintain the original cost in short-term trading investments trading in that one account so that they can compare it to when they sell it, the original cost. And now it's a realized gain or loss because it is money's exchanged hands, so the gain or loss is realized. You record any cash that you receive, but you have to subtract the broker's fee. So when you purchase them, you purchase it and record the cash that you spent for the investment, plus you'll add in the broker's fee as part of the cost of the investment. Now when you're selling them, you're going to record the cash that you received, but you will subtract out the broker's fee. Any prior period fair value adjustment to the portfolio is not used to compute the gain or loss from the sale of the individual trading securities. So in this instance, we received $10,000. Our short-term trading investment was $9,500, so that was the original cost. So the difference between those two is a credit, which will be a gain on the sale of short-term investments. So if the difference between the cash received and the cost of the investment on your general ledger is a credit, then it's going to be a gain. The difference between the cash that you received and the short-term investment is a debit, then it will be a loss. Now, the income statement account is gain on sale, not an unrealized gain. And when the period end fair value adjustment for the portfolio for the trading securities is computed, it will exclude the cost and fair value of any securities sold. So that will be taken both out of the cost and the consideration of the fair value. So any adjustments that would be made for the upcoming financial statement periods would just be those financial investments that you still have on hand. Available for sale securities can either be short or long term. Fair value adjustments are recognized on the balance sheet. So this deviates from those that are being actively traded, the trading securities, in the fact that the fair value changes will be recognized on the balance sheet. These are securities, either debt or equity, that have been purchased to yield interest, dividends, or increases in fair value. So you may be just holding the stock, it doesn't pay out any dividends, but because of the increase in fair value, so like if you had Apple stock and it's climbing in price, so that way you would be increasing the value of your investment so that when you eventually sold it, you would be realizing a gain. They are not actively managed like trading securities. If the intent is to sell within the longer period of 1 year or the operating cycle, they would be classified as short-term. Otherwise, Otherwise, they're classified as long-term. So trading securities, which is the one that we looked at previously, those are always short-term, but available for sale could either be long-term or short-term. Now let's look at valuing and reporting the available for sale securities. As with trading securities, companies adjust the cost of the portfolio of the available for sale securities to reflect changes in fair value. The purchase is recorded at cost plus a broker's fee, just like the trading securities, and a sale will be recorded at cost minus the broker's fee. It's done with the fair value adjustment to its total portfolio cost. So when we have a fair value adjustment on a financial statement period date when we're preparing them, then the fair value adjustment will be a fair value adjustment available for sale to differentiate them from trading securities, and also to let the readers of the financial statement know the intent of why the company is holding this investment. And then the unrealized gain will go through the equity or the balance sheet as a financial statement. So it won't show up on the income statement, the unrealized gain. It'll be shown on the balance sheet. Any unrealized gain or loss for the portfolio, again, it's not reported on the income statement, but is reported in the equity section of the balance sheet. So let's look at the purchase and sale of a non-influential investment. So what we're looking at now is we're going to purchase some shares of stock. The price per share on the market of the day that we purchased them is $25, so we're purchasing 200 shares. The total share cost for us is $5,000, and then there's a broker's fee of $200. So the total amount paid for the investment is going to be $5,200. And then we're going to divide that by the number of shares that we have on hand, and this is going to be the purchaser's price per share. So the company's price per share is going to be $26, not $25, because you have to add in the fact that they also paid the broker's fee, and that's part of the cost of the investment. So short-term investment available for sale. This could also be short-term investment, a trading security. $5,200 is what it cost us, and that's the value or the cost of the security. So we're just looking at this as though it's an equity transaction, but they could also be debt transactions. So this is looking at both an example of what could be a trading security or an available for sale security when we're purchasing equity. Now let's look at what would happen if we would sell 100 out of the shares that we originally purchased. So we purchased 200, but now we need some additional money, so now we're going to sell 100 of our shares. So the price per share that we're selling it, on the date that we're selling them, we're going to get $27 per share. So that's 27 times 100 shares that we're selling. So our total share cost is $2,700, and so now we have to take into consideration the fact that we're going to pay a broker's fee, so we're going to deduct that from the cash that we are going to be paying out. So what we'll be paying out will be we'll be selling the cash that we will be getting, rather, I'm sorry, I said that wrong. The cash that we will be getting will be deducted. The broker's going to take out the $125 from the sale, and so we're only going to be getting the net of that. We'll be getting $2,575. So the short-term investment, we have it on our books. We have 100 shares at $26 per share. So that's what we calculated it when we looked at it here. And so normally you would think, well, if I got $27 per share and I was carrying it on my books at $26 per share, certainly I have a gain. Well, actually, you don't, because you have to take into consideration the fact that you're paying out the broker's fee and you're getting a net amount. So you're not getting $27 per share, but they're going to take out the broker's fee before they give you your money. And so now you're only going to get $2,575. You're carrying it on your books, these 100 shares at $26 per share, so $2,600, and there's actually going to be a loss on the sale of the investment. So take all of this into consideration when you're looking at what the purchase value of the shares of stock that you're purchasing and what the value of it is when you're selling it. Now let's look at how we determine fair value. So let's look at an example of that. So this is a fair value adjustment on the financial statement date. And so these are all of the investments that we have, company A, B, C, and D. This was our original cost for each one of these investments. And now on the date of the financial statements, we have their fair value. The formula to determine whether there's a loss or a gain, and always we want to analyze the entire portfolio so we don't look at these individually, but of the entire portfolio, is to take the fair value and subtract out the cost. Then that will tell us whether or not we have a gain. So in this instance, our fair value was larger than our cost, so we had a gain. So then I have another example here wherein our fair value is lower than our cost, and in which example we would be recording a loss. So an unrealized loss, this would be an unrealized gain. So let's look at those as though this was a trading security. So fair value adjustment trading security. This is this example here where we had a gain, so unrealized gain income. And then let's look at this example as though we had a loss, unrealized loss income, fair value adjustment trading. And now let's look at what we would be doing and what the journal's entries would look like if we had available for sale securities. So this is our fair value adjustment available for sale securities. So this would be our unrealized gain, but here we're going through equity as opposed to up here we're looking at income because that's a trading security. And then unrealized lost equity fair value adjustment available for sale securities. Okay, so we have two different examples, one with the loss, one with the gain, and then the two different type of securities that we can be holding. So now let's look at something entirely different, the investment in securities with a significant influence. This is a long-term investment. So this is not speculative. We're not holding them just to get some dividend or interest with the eventual hope of selling them, and we're not actively trading them. We're developing a relationship with a particular company, and so we're going to be buying between 20% and 50% ownership of their stock. A long-term investment classified as, and this only has to do with equity securities because this is ownership of a company. So a long-term investment classified as equity securities with a significant influence implies that the investor can exert significant influence over the investee. The equity method of accounting and reporting is used. Long-term investments in equity securities with a significant influence are recorded at cost when acquired. When the company invested in has earnings, so we're investing in a company and now they have earnings, the earnings are recorded by the investor based upon the percentage owned by the investor. In other words, the value of the investment has increased. So let's say the company that we invested in, the reported earnings, so our long-term investment, the value of it is increased by $150, and now we're going to report earnings from the long-term investment in the amount of $150. Dividends will require special treatment under the equity method. The receipt of cash dividends is not revenue under the equity method because the investor has already recorded its share of the investee's earnings. So what they would do is instead, cash dividends received by the investor from an investee are viewed as a conversion of one asset to another. In other words, dividends reduce the balance of the investment account. So the investor company receives dividends, and they're going to record the cash that they received, but now they're going to decrease their investment in the XX company in the amount of $260, which is the dividends they receive. So let's go get an example. So this is an investment purchased by Lucky Company. They're going to invest a long-term investment in Happy Company in the amount of $540,000, and they're purchasing 40,000 shares, which represents 40% ownership. In 2014, Happy Company reports earnings of $1.2 million, and Lucky will recognize 40% of these earnings. So it's just like they're a part owner in the company, so they're going to recognize the fact that the value of their investment has gone up and this is 40% of $1.2 million is $480,000, and so then this will be earnings long-term investment. Next, in 2014, Happy declares dividends of $30,000, and so Lucky, which is the owner of these shares of stock, will recognize 40% of the dividends. Well, this is just like when a company pays out dividends, the value of the company or the equity section goes down because they paid out dividends. So Lucky's going to recognize the cash they received, and 40% of the dividends would be $12,000. So they paid out $30,000, 40% of that's $12,000. Then in 2015, Happy Company reports earnings of $900,000, so Lucky's going to recognize 40% of the earnings. So the value of the company went up because the earnings went up, so the value of the investment is going up. So Lucky reports on its books long-term investment, Happy Company, $360,000, earnings, long-term investment, $360,000. Then Happy's going to declare dividends of $10,000. Lucky's going to recognize 40% of that, cash $4,000, long-term investment $4,000. So now let's look, before we look at this last transaction, let's look at what's going on in a long-term investment in Happy Company. You'll have to do this in order to figure out what exactly the value of the investment is, because in 2016, they're going to sell a portion of the shares that they own. So we have to look at what is it valued at on the company's books, on Lucky's books, in order to figure out what's happening when we sell a portion of the 40% of ownership. So we have our original purchase. We're recognizing that our investment went up when they reported earnings, went down when they reported dividends, went up when they reported earnings, went down when they reported dividends. Add up all the debits, add up all the credits, take the smaller from the larger, and so now for those 40,000 shares, the balance of the investment on Lucky's books is $1,364,000. So now Lucky's going to sell 10,000 of these shares. And the open market on the day that they sell it is selling for $42 per share, and there's a broker's fee of $150. So the cash that they will receive will be 10,000 shares at the market value of $42 per share, which is $420,000 minus the broker's fee of $150,000. So the net money that Lucky will receive will be $419,850. Now, how does Lucky record the fact that they no longer have these 10,000 shares? Well, Lucky's value per share at present, after the 2 years of ownership, is the $1,364,000 divided by the 40,000 shares that they purchased. So in other words, it's $34.10 a share. So they'll record the 10,000 shares that they're selling on the cost, taking that cost off of their books of $341,000. So the long-term investment of Happy Company is going down by $341,000 because they're selling 10,000 shares. The difference between these two reflects a credit, which is a gain. So there was a gain on the sale of this long-term investment. So next, I have some information on investment in securities with a controlling influence. So let's just read a little bit about that, and it's just informational. It's covered in a much more advanced accounting class. So a long-term investment classified as an equity security with controlling influence implies that an investor can exert a controlling influence over the investee. Not significant, a controlling influence. An investor who owns more than 50% of a company's voting stock has control. This investor can dominate all of the other shareholders in electing the corporation's board of directors and has control over the investee's management. As the board of directors will hire the people like the CEO and the CFO and all of the people that are going to be running the company. So now they'll tell as the elected members of the board of directors, they'll be hiring people that they want in a company. So we'll use the equity method with consolidation to account for the long-term investment in equity securities with a controlling influence. The investor reports consolidated financial statements when owning such securities. The controlling investor is called the parent, and the investee is called the subsidiary. A company owning all the outstanding stock of a subsidiary can, if it's desired, take over the subsidiary's assets, retire the subsidiary stock, and merge the subsidiary into the parent. However, this doesn't happen often because there are financial, legal, and tax advantages if a business operates as a parent controlling one or more subsidiaries. When a company operates as a parent with a subsidiary, each entity maintains its own separate accounting records. From a legal viewpoint, the parent and each subsidiary are separate entities with all the rights, duties, and responsibilities of individual companies. From an accounting perspective, consolidated financial statements are required, and they show the financial position, results of operations, and cash flows of all of the entities under the parent's control, including all subsidiaries. These statements are often prepared as if the business were organized as one entity.